Hello and welcome. India and China are now faced off at the border. The question that we are asking, however, is as India tries to retaliate on the trade front by either imposing tariff barriers or restricting investments from China, how can that play out potentially? To what extent are Chinese investments already entrenched in India, either through the direct route or the non-direct route? Could ventures be affected? Could jobs be affected? Or for that matter, then could all of this be evened out because there would be a more level playing field? So to discuss this, I'm joined by two individuals who've been tracking the particularly developments on the trade front and the cross-border investment front for a while now. And one is Amit Bhandari, Fellow of Energy and Environment Studies at Gateway House, and Manoj Kevalramani, a Research Fellow, China Studies at Takshashila Institution. Thank you both for joining me. So, Amit, you also wrote a report a few months ago which sort of highlighted the nature of Chinese investments that were already in India and the extent that it had gone in. So, just take us through broadly what the top or the key takeaways at that time were.
So, Govind, the numbers we have indicate that China accounts for about $8 billion of FDI in India. And this is counting mainland China, Hong Kong, as well as Taiwan. So, in absolute terms, this is just about 1.5% of the total FDI stock within India. So, which is not very significant. We think the actual number may be slightly higher because some of the Chinese investment in India has come in via Singapore as well. So, we have seen that happening in case of Alibaba investments in Paytm. So the $8 billion may be slightly higher. The second point is that bulk of Chinese investments, based on our study, has come in the Indian startup sector. So we were able to identify 95 Indian startups where there is a Chinese investor backing them. There are 30 unicorns, 30 Indian startups considered to be unicorns, which are worth over $1 billion. 18 of them at present have a Chinese investor. And this includes Flipkart, this includes Ola, Oyo, as well as Byju's, the education company. The third sector where Chinese investments are fairly big is the electric vehicle or the automobile segment. We were able to identify 5 Chinese companies investing in India. And if we decide to go big on electric vehicles, we will probably again be playing into the Chinese game.
Right, that's interesting. Just a slightly lateral question, Amit. Is it possible that these Chinese investments have resulted in the catapulting of these companies into unicorn status?
That would partly be the case, yes, because obviously the unicorn status is based on what is your valuation. Valuation is based on the money you have raised. So, I mean, it is partly the case. And I think Chinese investors are one of the 5 big pools of capital which are investing in Indian startups, which also includes, of course, the American investors led by Sequoia, FANGs, SoftBank, and Naspers.
Right. Okay. Manoj, how are you? You've been studying this closely too. So how are you seeing investments, particularly now on the non-direct investment? I mean, we do a lot of trade. What are the numbers that you've put together?
So what we see is that, Amit's got the numbers largely on point. But then again, these numbers are so, government reporting is so odd from both sides that the numbers are really difficult to estimate. But when you look at it, there was a recent paper by Anand Krishnan where he talks about an estimated figure of, already invested and planned investments at approximately $26 billion. So there's much more money that's coming in. A lot of this has to do with the fact that some of the money that's coming in from companies and funds is coming in through Hong Kong, Singapore, Mauritius, different routes. And it's therefore very difficult to sort of track what this number is. What we do know is that we need to also look beyond just the numbers of the amounts that have come in. When Chinese companies are investing in sort of parallel companies in India, so for example, Didi Kuaidi investing in Ola, or Meituan Dianping investing in Zomato or Swiggy, one of the food companies, what you'll end up also getting is sharing of skills, sharing of market expertise, sharing of knowledge in their own markets. So you do much more than just provide money. The challenge from an Indian point of view is obviously, of course, in terms of what do we do with ownership, what do we do with data, who gets to make decisions in these organizations, and that's where our sort of challenges lie. As far as the money coming in goes, I think we need to be slightly careful in how we characterize this debate, because it's a very volatile debate in India at present, and it has been a volatile debate for some time. as long as companies are coming in to make profit from the Indian market, it's also reposing confidence in the Indian market. So I don't think we should see it necessarily as an issue, as a problem. The problem lies in sort of the nitty-gritties and the details. Ownership, who gets to sit on the board, who gets to make decisions about data, and those sorts of things. And I think that's sort of the area where we need to focus on.
Right. Amit, have you also been looking at trade and trade numbers?
No, Govind, sorry. I mean, mostly investments, not trade, not so much.
Right. Right. Okay. So trade obviously is the other part. I mean, so one is direct investments, and trade is where there's continuing contact. And for instance, there is. Like America has done. Could India be increasing its tariff barriers? And that's one question that's being posed. And Manoj, what's your sense? I mean, is if there has to be response, and if there is a clamor for response, and like America has done, is a trade battle or a trade response much more saner than any other form?
Look, I think if you look at the sort of composite nature of India-China trade, I mean, our trade last year was approximately $90-odd billion. And this is predominantly goods trade. So if you look at that, we're importing obviously a lot more from China. So for China, India is a valuable market. In the grand scheme of things, if you look at data from 2018, what you will see is that the export to India was approximately 4 to 4.5% of China's overall export in 2018. Now, that's not insignificant, but it's not necessarily consequential enough to really deliver a massive blow. It's not the kind of trade that the US has with China. It's not the kind of dependencies that those two markets have. So yes, you can impose tariff barriers, you can do those sorts of things, but I think we also need to look at how much that will impact us, because what we're importing from them is capital goods, electronics, things like this. And that's needed from an Indian point of view also. So I think we need to, before we take some of these steps and we say that we're going to raise tariffs, at the end of the day, the cost of that will be borne by consumers. And is it in consumer interest? And what's our larger interest? Will those tariffs deter actions on the boundary? I doubt that they will deter actions on the boundary. So what's the impact of that cumulatively is likely going to be far more burden on the Indian consumer, which sort of slows down our own sort of transformation. We want the Indian consumer to become wealthier, richer, to spend more, which stimulates the economy. And I think we need to therefore look at this stuff in the broader context.
Right. So one of the things that the government has already done is talking about preventing opportunistic takeovers arising out of COVID-19 like situations. Manoj, is that something that's already playing out in your mind?
I don't think we've done much in that context at all. What we've done with that note that we put out some time back. Look, to me, that note was an overreaction. Look, the government has said that yes, we are sort of we're taking this seriously, and this is a long considered policy. It was not a knee-jerk reaction. To me, it was a knee-jerk reaction. It was a reaction to the report of PBOC's stake going up in HDFC from 0.8% to 1.1%, which is insignificant in terms of decision making in the broader context. If government wants to review investments which are coming through these routes, they're going to slow down this. They're going to slow down the process of this money coming in at a point in time where India needs capital, particularly after COVID. We need to be really careful in terms of what we do, what sort of signals we send out to capital. And this is not specific to Chinese capital. Look, all money is good until the decisions are in our hands. And I think, therefore, we need to think about how we draw these regulations which protect our companies from takeovers. One model is the CFIUS model of the US, where you set a bar in terms of the amount of ownership and therefore the board seat and those sorts of things. And I think that's the kind of model that we should look at rather than sort of blanket oversight over every investment, which will delay the process of investment, which will then delay the process of an organization's growth and the subsequent downstream effects. So I think we need to be far more nuanced in this.
Right. Wonderful. Thank you so much, Amit and Manoj, for sharing your thoughts. And let's see how this plays out. And I'm sure I'm going to come back to you soon. Thank you so much for joining me.